Welcome to Crypto Insights Lab, where meticulous analysis meets the dynamic world of cryptocurrency. In this episode, we'll dive into Archway, one of the latest permissionless smart contract platforms in the Cosmos ecosystem. We'll exploring its unique features, the dApp ecosystem, the challenges it faces, and offering a glimpse into its future with a thorough assessment of its potential. Let us first look at what Archway is in a nutshell. Archway is one of the latest permissionless smart contract platforms launched in the Cosmos ecosystem. It aims to rebalance incentives between developers building decentralized applications, node operators securing the network, and Arch token holders providing capital. With clever tweaks to tokenomics and revenue flows, Archway hopes to better reward long-time contributors proportional to the value they provide. The main ingredients are usage-based rewards for developers, and the ability to charge premium fees at the contract layer. Traditional economic designs of Layer 1 chains lead to protocol layers accruing value over applications built atop them over time. This can be observed with the likes of Ethereum and Solana capturing more wealth than the application running on them. To avoid this, some ambitious applications are opting to launch custom chains from scratch to better monetize their work. Archway offers an alternative middle path. Contract creators earn rewards directly tied to the usage of their smart contracts. This allows developers to benefit from the chain's security and interoperability while still capturing value from their applications proportional to their usage and contributions. These mechanics attempt to realign compensation, value distribution, and incentives in some creative ways. Additionally, Archway provides a bridge for applications that outgrow a single chain. Successful projects can migrate to an app-specific sister chain secured by Archway's validators rather than fully fragmenting. This maintains alignment between Archway and its breakout dApps even as they scale up. Next, let's examine Archway's unique tokenomics and how they aim to incentivize an ecosystem of aligned builders and contributors. Several novel components work together to reshape compensation and sustainability. Archway's value capture engine consists of three elements: gas fee rebates, developer inflation rewards, and contract premiums. Let's look at gas fee rebates first. On most proof-of-stake chains, transaction fees get redistributed to validators and stakers. Ethereum instead burns fees, limiting inflation. This captures value for ETH holders, but leaves contract creators empty-handed. Archway implements a modified approach. 50% of fees get burned, while 50% goes directly to the developer of the smart contract that incurred those fees through usage. This ensures creators earn rewards proportional to the value their contracts drive for Archway. The more transactions and fees driven by a contract, the higher the rebate to its developer. This aligns incentives by tying builder revenues to usage of their contributions. But developers aren't limited to 50% of contract fee revenues. They can earn additional inflationary rewards. Each block, a portion of monetary expansion is reserved for smart contract creators active on the network. This allocation gets distributed pro rata based on what percentage of the block's transaction volume came from a developer's contracts. So if a developer's code drives 10% of transactions in a block, they would receive 10% of the inflationary rewards. The more usage and fees created from a specific smart contract, the bigger payout the developer gains. Beyond gas rebates, Archway provides a customizable fee layer at the contract level for flexible monetization. Creators can configure additional usage fees paid alongside the base gas costs for transactions. This composable premium model enables builders to incorporate traditional business models into Web3 contexts. Not only can dApps charge custom premiums for different contract executions, but those building network tooling can also charge the applications using their tooling through custom premiums. This provides routes to sustainability for both applications, catering to end users and builders of network goods and services, who have previously been forced to rely heavily on grants and external payments. With usage driving rewards, a valid concern is developers spamming transactions on their own smart contracts to farm the dev inflation token rewards. But Archway's tokenomics are designed to disincentivize this. Thanks to reflexive gas prices, spam attacks will increase in cost rapidly, and notably outpace the increase in developer rewards. The 50% gas burn necessitates burning significant amounts of the Arch token to carry out an attack of any significant duration. This renders spam attacks both impractical and deflationary. Interchain security, also called replicated security, is the Cosmos Hub's model to bring value to the Cosmos Hub and its Atom token. Archway has forked ICS to provide interchain security services to bonded sovereign app chains themselves. As applications built on Archway might become a huge success and grow to a transaction volume or an evolved business model that requires them to have their own chain, they can seamlessly transition from being a dApp on Archway into becoming a blockchain secured by the Archway validator community. Positioning Archway not only as a Layer 1 chain, but also as a security provider allows successful projects to avoid detachment from Archway, remaining closely integrated. The relationship becomes mutually beneficial. Applications gain security. Archway gains valuable revenues. Next, let's look at Archway's early adoption. As a newly birthed chain, Archway's developer community remains small. The flagship application so far is Astrovault, an innovative decentralized exchange. Most DEXs cannot generate enough revenue from trading fees to cover liquidity mining incentives to attract users. This necessitates unsustainable inflationary rewards. Astrovault provides a creative alternative using staking derivatives. Users stake assets in non-compounding pools, while Astrovault earns yield on the underlying staked assets, accumulating its own protocol-earned liquidity. As the Treasury accrues more protocol-earned liquidity, it no longer relies on external liquidity providers. Earnings can be shared with users through staking rewards and buybacks, rather than endless emissions. This better aligns user and protocol incentives. The more assets staked, the more self-sufficient Astrovault becomes. Users similarly benefit from gains as the protocol grows. Astrovault represents the innovative thinking Archway hopes to catalyze. To adopt more such applications, Archway has to overcome some challenges. Let us explore these. As an unproven upstart, Archway must overcome tall hurdles on the path to proliferation. Adoption remains minimal in these early days, with only about $1.25 million total value locked and around 6,500 weekly active users. This is comparable to some other Cosmos ecosystem projects, but far below major Layer 1s. Significant growth is badly needed. These numbers highlight that despite its innovations, Archway faces uphill battles. Let's explore the key challenges ahead and potential solutions. Gaining sufficient developer and user adoption poses the largest challenge for any new Layer 1. Archway must overcome the first-mover advantage of entrenched competitors like Solana and Polygon, who already have multi-year head starts in ecosystem building, as well as better capitalized newcomers like Sui and Aptos. A few flagship applications that generate buzz and attract excited users to boost the landscape will be necessary for Archway. In the hope of adopting users quickly, builders tend to flock to ecosystems with a well-established user base. This is why the Layer 1 space has become so difficult to gain a foothold in, and why the market consolidates to a handful of dominant platforms. Incentivizing builders across different verticals will be crucial. If Archway gains an initial foothold of engaged users, network effects can take over. But first it must kindle that initial spark of interest. The path forward is offering an innovative platform with tangible benefits and utility beyond existing options. Archway is well positioned here, but success relies on execution. The team must aggressively communicate strengths and conduct extensive outreach to attract pioneering projects, as well as offer strong financial incentives for builders to take the additional risk and launch on a not-established platform. Once the ball gets rolling, a positive feedback loop can be ignited. But to get there, Archway has a long way to go, and ecosystem development will remain a steep uphill climb. A second large question mark is if gas rebates can ever generate meaningful revenues. Archway's developer revenue sharing model is innovative conceptually, but reasonable doubts linger around its long-term viability. With minimal gas fees, rebates will likely remain negligible in practice. especially given the trend of consistently making block space even cheaper. At around 1 cent, Archway's base fee level aligns with other Cosmos chains. Such low fees are fantastic for end users, but it seriously calls into question whether gas rebates can realistically translate into sustainable revenue streams for application developers building on the platform. An application would likely need to facilitate tens of thousands of transactions daily just to have a shot at producing a few $100s worth of revenue. Of course, inflation rewards allocated to developers help for now, while projects remain scarce. But as the ecosystem matures, more applications will dilute those fixed pools, exacerbating the pain of low revenues of gas rebates. Raising fees may seem an obvious solution. However, for many applications, minimal fees are non-negotiable. Decentralized physical infrastructure platforms rely on high-frequency, low-value transactions. Higher costs could completely destroy their user experience. There are no easy answers here. Archway faces a delicate balancing act, keeping fees high enough to fund revenue sharing and sustainability goals, yet low enough to remain accessible to a diverse range of applications. Developers' ability to raise gas fees helps by letting unaffected projects boost revenues, but tuning the base rate itself remains a knotty challenge. As an ambitious young Layer 1, Archway shows potential, but has a steep uphill climb ahead, earning mindshare and users in an increasingly crowded field of competitors and alternatives. On a conceptual level, Archway's novel tokenomics and incentive flows represent an intriguing attempt to improve sustainability, better reward contributors, and nurture a thriving ecosystem of aligned participants. But differentiation and clever economics alone are insufficient to ensure success. In order to genuinely stand out, Archway must also nail community building, foster an engaged contingent of supporters, and foster an ecosystem of excellent end-user applications. To achieve its goals, the Archway team must stay relentlessly focused on incentivizing and supporting builders and creators willing to take a chance on building core applications, especially now in the platform's earliest days. This requires generous hands-on guidance, first-class developer support, seed funding and grants for initial projects, and creative targeted incentive campaigns designed to kickstart that viral application growth flywheel. For now, Archway remains one to watch closely as its carefully crafted mechanisms around incentivization, usage monetization, and sustainability are tested to find product-market fit. If the team can gain developer mindshare and nurture a breakout ecosystem of apps and users, Archway may well become a leading Layer 1 in the Cosmos ecosystem, and maybe even beyond. Thank you for joining us today at the Crypto Insights Lab. We truly appreciate your time and curiosity. If you found our analysis enlightening, please consider subscribing to our channel. Together, let's continue unraveling the intricacies of the crypto realm. Until next time, stay curious and keep exploring.